back to another episode at Economics Design. Today we're going to talk about the protocol FEI, and we're going to analyze the economics of FEI and the failure of FEI. But more importantly, we want to come from an educated perspective, we want to come from an educational perspective to understand what went wrong. Before I begin, just a disclaimer, this is not investment advice, only educational. We're going to cover a few things today. What is FEI? The token design of it, the direct incentives, as well as the valuation of FEI, how it works, and then what went wrong, the 3 economic lessons that we can take away from this, as well as some general opinions of FEI. So, what is FEI? FEI is a stablecoin. It's an algorithmic stablecoin that rebalances using very interesting mechanisms that we'll talk about later. The general idea of FEI is that it has very interesting novel ideas in engineering, but that's where engineering and economics is quite different, because engineering is pure tech, it's pure systems design, and it's beautiful. It is genuinely an art. I love engineering. People who excel in engineering, thank you for existing, because you're an art. You're creating art. It's beautiful. This is where economics comes in, because economics is taking this engineering stuff and add in the human elements. And that's why economics is not really science per se, it's social science, because there's a lot of elements of human behaviors that we can't exactly model. And this is the story of how the human behaviors are not being aggregated into analyzing how robust these amazing, beautiful systems are. And that's what we want to talk about today, because the human element is actually really, really important. So just a quick summary of FEI. You probably have heard a lot about FEI, understand the project, a lot of people are talking about it, and I'll just give you some very high-level summary. Firstly, there are 2 tokens. There's FEI and Tribe. FEI is an algo stablecoin, and it changes the supply to maintain that $1 peg. And then they do a lot of other things as well to maintain that $1 peg. Tribe is the governance tokens, in which you can use the governance token to be voting on different kind of things. How is it special? It sold ETH for FEI. So it's not like Maker, where you are depositing your ETH to borrow out your DAI. It is selling ETH to get FEI out. Then you can sell FEI to get ETH back. But it's a trade, Your ETH is no longer yours once you sold it. The other special thing is that the protocol owns part of the asset, which is a big thing that we're going to talk about later. They call it the PCV, the protocol controlled value. And one special thing is that there's direct incentive and punishment to the users through taxation and subsidizing. The other thing, why it's so big, is because it raised $1.3 billion in ETH. They raised the first billion in 24 hours. So that's pretty cool. So let's get started with token design. Token design in the economic design framework is the last column. And we want to talk about direct incentives, which falls under the category of ROI, return of investment. Or actually, it focuses on the bigger category called financial incentives. Because financial incentives is the different kind of things we embed into the system. So in FEI, we talk a lot about direct incentives. What are direct incentives? Right now, they don't have, as of 15th of April when I'm recording this video, they don't have this incentive anymore, or they don't do the penalty anymore, but there's a screenshot where these penalties were evident. So you have direct incentives where you can see you can buy and sell FEI at whatever value. So the USD value, let's say, is 95 cents. And there's a penalty added into the system where you will remove some tokens. You're punished by adding additional tax. So when you take one FEI out, which is valued at 95 cents, you're losing additional 0.23 FEI, and you are effectively, in this diagram, you're effectively only getting back 77 FEI. So in general, about 77 cents. And that amount in ETH is worth 0.00036 ETH. And so this is the direct incentive that they have provided. So as I mentioned before, to get FEI, you put ETH in, and let's say ETH is worth $2,500, you get 2,500 FEI back. That's it, stage 1. Once everything is in place, when you want to sell ETH for FEI, then if the price of FEI is below $1, then you're taxed, where you have to pay additional tax for liquidating your FEI. So the general idea is good, because now that it doesn't make any rational sense for you to remove your FEI when prices are low, and you have to pay additional taxes, so it becomes double whammy where your FEI is worth so much less. And in general, you think that people don't want to take it out because that's just not rational, and that doesn't make sense. But the thing is, that's not exactly what happened. When prices fell even lower, people started to get fear and uncertain about everything. They started doubting the ecosystem, and they wanted to get money out. And as a result, more and more people are trying to sell their FEI, suppress the prices. The penalty got even larger and larger, and things kind of went a bit south. So that's the general idea. How do they calculate this value? How do they calculate 0.23 ETH? So it's basically the USD value, 95 cents, and the difference between that and $1. So that's 0.05. They only have 2 decimal places here, but it's actually a long string of numbers. So it's about 5 cent difference. So the penalty is a square of that mistake, or a square of that difference. So 5 square is 25. So the penalty is about 23 to 28 cents. So around 25 cents. So that's the general idea. And if you go with that concept, the biggest difference that you can get, the biggest penalty is $1, right? 100 cents. And that if you square root it, is 10 cents difference. 10, because 10 squared is 100. That means the biggest difference that FEI is trading at on Uniswap exchange, the biggest is 90 cents. So if it drops below 90 cents, you're effectively you have to pay to liquidate your FEI. So that's the general idea. And because a lot of people started liquidating, and the system didn't hold up, because the system didn't think so much about, didn't expect such a big thing to happen. And as a result, they stopped the penalty. They stopped these direct incentives and direct punishments. So this is for the punishment side. The incentive side is when FEI is less than $1, when you mint more FEI by putting ETH in, then you get bonus FEI as a result. So that's the general idea. Okay, later we'll talk about why when FEI dropped, people are not minting more FEI. It makes sense because they're basically getting free money, but they're not doing that. But why? So we'll go into that later. But the other aspect I want to talk about in token design is valuation. In valuation, how does the system go about with valuation in FEI? It uses this thing called reweights. So reweights is basically, remember I talked about how the system owns part of the protocol? So it's called PCV, Protocol Controlled Value. And this PCV, it owns part of FEI, it owns some amount of FEI, it also owns some amount of ETH. And how it works is that it manages in the pool, it manages part of the pool, and to get that rebalance, to get ETH, the amount of FEI equals the value of ETH in USD, they will do a rebalancing or reweight once every X amount of time. So that means by removing a huge chunk of money for a while, rebalance things so that one FEI is equivalent to almost $1, and then put the other tokens or the other remaining value of the vault back. That's the general idea. It's just reweighting. And it executes it to rebalance FEI. So to put it in a more simple to understand concept, it's similar to the bond system by ESD, empty set dollar. And one of the problems with ESD is that when you start out this system with a good thing in mind, right? You're looking to create something good. You're looking to create a more robust system. But when you have these kind of systems, you have whales trying to game the system. A good amount of people that went into the ESD ecosystem, they're now multi-millionaires because they gamed the system. Is it good? Is it bad? That's a whole another topic to talk about. But you can game the system. And in this way, you can kind of game the system with this whole PCV reweighting stuff, which is where it becomes quite dangerous. Because there's some calculations to show that if you have a lot of FEI before the reweight, then you actually get to earn a little bit more FEI as a result. And so because they're reweighting at a specific amount of time, or they frequently reweight, then you can have bots front running the reweight and getting these free money, gaming the system. But if you don't reweight so often, then it's hard for FEI to hold the pack, and then you are punishing people trying to liquidate FEI, and it's not beneficial to the users. So this is where a conundrum comes about, because you have frequent reweights is good to maintain a pack, but you've got bots front running it, and you can unfairly reward certain kind of people. And then when you have less reweights, you don't hold the pack and you're punishing everyone in the system. So it's a lose-lose case. So that's the general idea of how the token is designed. Let's take a step back to understand what went wrong. And let's look at things from an economics perspective, because it's all about economics over here. So there's 6 main economic fundamentals. Supply and demand, you know that already. There's incentives, punishments, and behaviours. I've been talking about that for 3 years now, so you probably should know this by now. I've also written a big chapter in the book. And the other thing that it's also a very important fundamental, that it's kind of like you just take this knowledge for granted if you study economics, is the willingness to buy and sell. And this is very important because the willingness to buy and sell dictates people's behaviours. So supply and demand, you understand that. Willingness to sell and buy dictates the supply and demand, and it dictates the fundamental underlying behaviours of people. Punishments and incentives are how you affect people's behaviours, and behaviours are the thing that we want to manage, the things that we want to learn how to analyse a bit more. So let's look at three areas or 3 categories in which the FEI ecosystem went wrong. The first one is mechanism design. Remember what mechanism design is? Mechanism design is the rules of the game, the rules that the participants and the tokens have to abide by. So they really constrain what you can do, what you can't do. It could be governance, it could be how you make bargaining, how you price things, how you get additional information, different kind of rules in the game. Mechanism design. So in mechanism design, the fundamentals that we're looking over here is incentives, punishments, and then supply and demand. So there are 3 areas of mechanism design that I want to talk about. The first one is there's free money via arbitrage, there's free tribe tokens, and this direct incentives has this effect has a greater effect in a circular economy. So let's get started with free money via arbitrage. So where does arbitrage come in? FEI is a new protocol and it's a stablecoin. So to bootstrap this stablecoin, to bootstrap the protocol, you have growth hacking. One of the growth hacking methods is through these bonding curve launches. So FEI launched on a bonding curve where people put ETH in to get FEI out, and to incentivize people to come in earlier, they get a bigger discount when they come in first. So for example, if you come in early, you get to buy FEI at 50 cents, whereas you know that FEI is trading at $1. So then you can arbitrage and get the free 50 cents. So that's the general idea. And so you have free money via arbitrage. You also have a lot of big VCs backing, so a lot of VCs are putting money in first, and then other people putting money in because everyone's talking about it online, and there's free money to be made because of the arbitrage. So that's where this mechanism is great to bootstrap your economy, but also you're probably attracting the wrong kind of people because you're attracting people who are looking at quick gains, quick wins, and as long as prices reach $1, you're willing to liquidate even if you have to pay some amount of money because you're already making money through the arbitrage. So that's one issue. The second issue is free tribe tokens. So the bonding curve ends at $1.01, so 1.01. And you're thinking, okay, if I am going to put ETH in, I'm going to take FEI out. FEI is worth $1, but I'm going to pay FEI for $1.01. What's that to gain? I'm actually losing 1 cent. Well, what's there to gain is the tribe token. So anyone who puts ETH in to get FEI out, they're also rewarded with tribe tokens. So this is where kind of like the protocol prints free money and just gives out the monopoly money, kind of something like that. And this monopoly money is tribe tokens. So these tribe tokens are basically your governance tokens. So if you value tribe token at more than 1 cent, it's rational for someone to put ETH into the system to get FEI out and tribe tokens out. Because if you value tribe tokens at 2 cents, which is right now I think it's trading at about $2. If you get tribe token out at 2 cents, then you're basically getting 1 cent for free, right? Because you value it at 2 cents, you're paying 1 cent for it, so you get 1 cent for free. And then you sell tribe tokens after. So this is also the other thing that happened. And so you have very direct incentives. You have the bonding curve incentive, you have the tribe incentive, and the other systems as well of the taxation or the subsidy when FEI goes above or below $1. These are direct incentives. This is the general mechanism design. And one of the problems is that it affects this circular economy, because direct incentives in a circular economy, things are very closely related to each other. It's like a constrained loop or a little world on its own. And money doesn't really go out, it just continues to stay in the system. And when money keeps staying in the system, the things that you want to consider is definitely the secondary and tertiary effects of how this free money via arbitrage and free tribe tokens will be affecting in the long run. So free money, free money via arbitrage and free tribe tokens. It's going to be your direct incentive, your first order effects, which means people rushing in to put money, people rushing to put ETH in. Then there's a secondary and tertiary effect, which is going to be what happens when you've got people rushing in, what happens when you have a lot of people putting money in, what happens when you've got people trying to liquidate, what happens when you have this kind of people coming in. And that brings us to the second point of secondary and tertiary effects, because that's something that you really have to consider. The fundamentals here are supply and demand, willingness to buy and sell. And here we're looking at the tribe supply. So we talked about how the system is just giving out tribe tokens for free. And because of that, the tribe tokens that you sell, it's going to be risk-free, because if you're the early comers or the early users, then you're already earning free money through the bonding curve, the arbitrage, and then you're also getting free tribe tokens. So the tribe tokens, they don't need any value. They're risk-free money for you. And because of that, there's not much incentive to want to hold it. So you're just going to sell it in the market. And it caused a big sell pressure in the market. And then because of that, it depressed the prices quite a bit. The other thing is that there is the only way to get out of tribe. The only way to make profit out of tribe is for you to turn tribe tokens into FEI, turn FEI tokens into ETH. So you see that jump? Because there is no USDC and tribe pool. It's just tribe, FEI, and then the only way to liquidate FEI is through ETH. So you have to jump through a lot of hoops to get your free money out. And so a lot of people are rushing to get the free money out because it's the gold rush. You throw all your money, you dump all your tribe tokens, you buy them, you turn them into FEI, and then you want to sell the FEI. And so that brings us to the next point on the willingness to sell FEI, liquidation. Because number one, you're more willing to sell FEI because you're going to make profits via the arbitrage. And second, you want to cash in your tribe profits. And so you can have some discount. It's okay. You can still afford it because you're really going to get profits in those two ways. So a bit of discount doesn't matter. And so you see a lot of sell pressure there. And because of that, other people are also worried and other people are trying to sell as well. Then you have a kind of secondary and tertiary effects that I was talking about. And the other secondary and tertiary effect is the willingness to buy FEI. So you're thinking, all right, FEI is less than $1 now. And the incentive mechanism is to get people to put more ETH in to mint FEI out so that they can be getting more FEI. And why aren't people doing that? Well, the thing is because in the secondary effect, that's the primary effect, right? The primary effect is the direct incentive where you're putting ETH in, you get more FEI out than the usual FEI that you have. The secondary effect is that, all right, I'm putting my ETH, which is quite liquid, turning them into FEI, which is stable, kind of. And what now? Who accepts FEI? Where can I use FEI? And even if I can't use FEI, I can sell FEI back for the price that I bought it at. So that's just not cost effective. That's not rational. that is kind of silly to do that. So people are not willing to buy FEI. So people are rushing to sell, people are not willing to buy FEI, people are constantly trying to liquidate FEI because they want to cash in on their tribe returns. And because of that, there's more and more, secondary and tertiary effects. And that brings us to the people in the system, communities and VCs. The fundamental we want to talk about here is behaviours. So firstly, there's information asymmetry. There are people who have more information first, perhaps, I don't know, but it seems like there's an information asymmetry. Looking at the Twitter threads, looking at the chats that's going on, it seems like there are some people who have more information than the others. Given that, they're able to profit off some stuff, or they're able to get into systems earlier and benefit a lot more than others. That's information asymmetry. The other thing which is more concerning is fear, uncertainty, and doubt. FUD, F-U-D. And what FUD is doing, together with whatever I talk about in secondary and tertiary effects, is that because people, in general, let's say people with information asymmetry, they have more information, they get free tribe, they get free alpha, they're trying to cash in their profits, and they're selling FEI. And they're okay with a bit of discount because they're going to make money anyway. With that discount, they're still making money. So with that system, they're willing to sell and put a little bit pressure on, like sell pressure, but it's okay, they can afford that risk, they can afford that fees. What happens to other people, the retail guys who they don't have this information, they see that there's prices are dumping, people are selling, and they get very worried. And the fact that the price is low, the fact that there is punishment, there's taxation, and people are still liquidating, worsens the fear of these people who don't have the information. And as a result, no faith, losing, quite uncertain, a lot of doubts, and you're trying to sell as many tokens as possible, even at a discount. So it became this tertiary. This is really a tertiary effect because it's really a step further, and it worsened this entire cycle. So what are the economic lessons that we can learn over here? Number one, game theory. Of course, I have to talk about game theory. So in game theory, you see that the general idea is that punishment fees, these taxation fees, they can help to restore the prices when prices are suppressed below $1. So, but the problem is that because of the fear, uncertainty, and doubt, because of the tertiary effects of behaviours, the punishment fees actually worsen the whole amount of money, the whole punishment, because prices are already low. You're punishing people from liquidating and increasing the punishment, and so prices are even lower. Firstly, people are less likely to return, and secondly, if you don't think that there's a future to it, if you don't think that there's an expected value, there's a good future to it, you want to liquidate right now because you want to cut your losses. And the direct incentive affects people's expected future of what the system is, because everyone is leaving, there's a lot of uncertainty, no one really knows what's going on, and it just doesn't look good. And not only does it not look good as you as an individual, because you can have your own doubts, but if everyone else is confirming your doubts based on the incentives that you see, based on the extreme high fees that you have to pay to exit, this is like a confirmation, a community confirmation. Think of it as community oracle, where everyone is signaling to you that this system, this protocol, it's not going to make it. So just leave now. So even if you have these kind of doubts, what people are doing, they're collaborating or coordinating to exit the system as soon as possible. So because of that, you also want to exit. And it really worsens the fear, uncertainty, and doubt. The second thing is secondary effects. In algo stablecoins, when one of the things is that the easy thing to do is if the coin is worth more than $1, it's easy. You just increase the supply. But if it's worth less than $1, what are you going to do about it? That's a $1 billion question. And literally, it's more specifically, it's a $1.3 billion question. And anyone who can solve that will get a lot of benefits. The thing is, this secondary effect tokens, it's not just about figuring out how to manage when it's below $1. It's about considering the secondary and tertiary effect. You have to model all these economic effects to understand which system is the most robust, which system works best, which systems correspond to people's behaviors best. It's not just about engineering, it's also about the economics consideration, the economics modeling of these beautifully engineered systems. And lastly, it's dynamic engineering. So this is a situation where we are looking at how you have to constantly engineer the system. You have to account for changes in the ecosystem. You have to account for the participants in the system. You have to account for the collaterals received. I don't think FEI protocol expected so many people to put money in. This system could probably work if you don't have that many people coming in. And also, this system could work if you don't have a lot of people FOMOing in, if you don't have a lot of people looking for a quick buck. This system could potentially work where you have a lot of believers in the start. And lastly, look at the economics design framework, because the framework, the one that I created, it really helps you to look at what are the different aspects and areas you have to consider, what are the different things you have to model in the economics behavior, model in the engineering aspect, model in the financial aspect, build, test, and develop. Keep thinking, keep remembering that you have to test them. You have to keep testing and keep ensuring that these systems are what it's supposed to be. So run simulations, run tests, run some basic Monte Carlo simulation to understand what your effects are. And so what will be my opinions on FEI? Firstly, genuinely, this is a great experiment. It is a great experiment for us to experiment and figure out new mechanisms to play around with, because right now, there are still a lot of unknown mechanisms out there and we don't know what is the best mechanism. So we're still experimenting, we're still playing with it. And I think this is a great time to allow us to experiment and be open with experiments. I don't think FEI is an outright failure. I think FEI is a great experiment for us to learn a lot of things from. So be kind to people who are working on FEI, because it's not easy for them. And in a bull market, it's very easy to want to rush into projects and then just release it. I can understand that, because that's where you can get amazing funding right now. You can get a lot of people excited. But remember that you have to test, you have to analyze, you have to research, you have to make sure that your system is robust. You have to test that your system is robust. You have to check your secondary, your tertiary effects. You have to make sure that the system you build, the system you're engineering, is the system that people will react to, people will behave to, because that's something that's quite hard to model, but at least have a baseline model to just test if your system works. Test with code and not test with people's money. That's something good to think about. And lastly, I just want to throw it out there to you guys. It's, what do you think the moral obligations of early investors are? Because there are a lot of significant people with influential status on Twitter and just shilling FEI. And FEI can be quite complicated for a lot of people. And it's kind of hard to see the difficulties initially or the challenges initially. So I think there is a moral obligation for early investors before they show these projects. They need to explain how it works, and for people who buy into projects to understand how it works, because this is very important. I mean, I wish I read about FEI in January, I had written a piece about it, because that's why I didn't put money in FEI. And of course, it's easy to say it right now, but I think there's a moral obligation for early investors to want to educate and protect other people too. Otherwise, it's just going to be these early investors or people with information asymmetry coming in and rug pulling other people who came in late. It's not even the protocol's fault then. So it gets a bit quite challenging, and I think VCs and funds and people of interest in the space, it's important for them to act wisely, because this is a decentralized ecosystem. And if you have a few significant people moving the space the way they want to, then it really is nowhere near the Wall Street that we're looking at right now. So I think that's something that we should definitely consider. So that's the end of this week's episode. I hope you take a lot away from it. And I think it's going to be a very interesting case study moving forward. So we're going to talk about a lot of other mechanisms, a lot of other protocols, and experiments, what works, what didn't work, and hopefully it helps to educate you as you do your own research. I have a book, the Token Economics book. Check it out. If you're interested, please buy them. Please buy the original one. And looking forward to seeing your order. So then, I'll see you in the next episode. Bye!